And on today's show, annuity income with SPIAs, DIAs, and indexed income riders. Part 2 of this week's series on the Final Four product review with nationally recognized annuity expert Mike McLaughlin. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician and Insmart. Let's get down to business. Well, welcome to day 2, Mike.
Thanks for having me.
I appreciate you coming in. We're talking about income. Now, when we talk about income, we're talking about single premium immediate annuity. We're talking about deferred income annuity. We're talking about GLWB on indexing. And we're not going to do variable, but there's a whole nother plate for that. Let's talk about today what's working for income and give me some yin and yang. Why would I consider any one of those three?
Well, first of all, I think that control is a big issue. When you talk about single premium immediate annuities or deferred income annuities, you're generally talking about loss of control. Not that you give up complete control because you can get it back in emergency, but this gives you ultimate control. You as a client control where you're placing your money, control the availability to pull that back whenever you want to, but you still get a guaranteed income for life, depending upon the income value and the payout structure, depending upon the different contracts. What's most important about fixed index annuities, though, is the base chassis. What's going on within the base chassis? What options do you have in terms of crediting methods? Because at the end of the day, if you want control, you're thinking that you may pull that asset out again and use it for other deployment. You want to make sure that you have the right accumulation vehicle back
Well, we're
there.
looking at several of your indexed options here, and some of them, of course, most of them are all going to have, I would say, the basic vanguard of domestic. I don't see too many foreign. There might be some here, but I don't see any real foreign here. But when you're looking at 100% participation rate and you're looking at the different carriers that we have here, which one stands out to you as some of the, what you would say, these are the players right now?
I believe that the Allianz 360 is probably our one that we're gaining the most market share right now and the fastest growing within our distribution system. One is that it has a tremendous amount of options within it for different clients. It has a great income rider, which is really important because it's the only income rider that will actually increase. What it does, it takes the last year's check times this year's gain, and that's your new check. So if you have a gain of, say, 5% within the index, the underlying index, your check goes up by 5%. That is very unique for them. It's a great way to help offset the impact of inflation, which is probably the cruelest tax of all.
Now, I just want to make sure, if I was looking at that and I was comparing to present day SPIAs and DIAs, how would that look?
It would start out a little bit less because the payout structure is less. You're still using on a LIFO basis, so you lose the tax advantages of a SPIA. However, you still gain the income that you'll never outlive, and plus you have the availability. What's really unique here in the Allianz product is the Barclays Dynamic Balanced Index. It's a unique uncapped strategy, currently has a spread of under 3%. So when you think about the comparisons of variable annuities of mortality and expense, active asset management, plus a very expensive income rider, those typically are well over 3%. You can get all of that all within about a 3% cost for you.
Now, you're paying the spread, you're not doing a cap, it's 100% participation.
Absolutely.
So you like this in an overall product point of view and income. Is there anything in here that you see that really also has what you would say, this has huge potential? What's your top number up here? If I wanted to say, I have a potential of getting what, 7, 8%, anything up on this board for that?
The other thing that's significant here in today's current cap environment is the Cap Max strategy from Genworth. It really puts the client in control of how they want to utilize their index gains. Let's say that the current Cap Max or the current cap is say 4.5%, has a multiplier of 3%. What that does, Steve, is at the end of the first year, and let's say that you've maxed out your cap at 4.5%, you can go ahead and do the Cap Max, and next year you can get 3 times that 4.5% rate, so that gives you much more of the index in year 2. You forego your interest in the first year, but you make it up in the second if you believe that the market is still going to go in an upward setting.
Well, when I'm looking at indexing, I'm trying to always see, well, what is the cap? I notice that some of these, when you have a no cap, no participation rate, and we're living off the spread, as you said in the Barclays scenario. Are there other ones here that you would say that also have, they're shorter? So this one seems to be a lot longer in its period for surrender charges, but I also noticed that there's a few here that are 5-year.
Yeah.
When you look at this short term, are this worth looking at from an index point of view?
We think that from a 5-year standpoint, you can still make great gains over CDs and other fixed accounts. Really, the index only has to go up 3 of the 5 years in order for you to beat the current fixed rate environment of about 2.3%.
Now, when you say fixed rate, are we talking about fixed annuity
fixed guarantee, rate? Yeah,
okay,
rates,
that's a great point, because now we're comparing, and a 5-year plate, we know what we get in the fixed. We did that on yesterday's show. Now I can compare those rates to this contract and say, is this a better deal? And when you're looking at this, how's their track record with these kind of contracts, like Safe Outlook and Keystone?
Keystone 5, again, from Reliance Standard, their renewal of their cap strategy has been very, very solid. The same thing for Safe Outlook. And one thing the Great American does is they put their money where their mouth is. They provide a bailout so that if they go 50 basis point below their initial rate, you can walk away with your money with no surrender charge.
Without a surrender charge. Well, I love all this. Listen, when we come back after the break, we're going to talk more about some of these payouts and some of the options that you have for income, because you shouldn't really think about just sticking with the contract. You need to look at all SPIAs, DIAs, and GLWB options just before you hit the trigger. We'll be right back after the break. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Now let's look at some of the income rider comparisons between companies and carriers, and kind of walk us through. There's a lot here, and I wish we had more time to really unbundle and unpackage this, but walk us through what you think, Mike, are the highlights of the income rider comparison chart. And by the way, remember, you can get all this free. Just write me, steve.savant@ashbrokerage.com, and I'll be happy to send it to you.
Again, I think there's a couple things that you want to take a look at. Just like we talked about on the fixed side, when can income start? Some of them are immediately. Sometimes you have to wait for 5 years or 10 years. So it's really key to understanding when that client is going to turn that on. And if you want to control that trigger, you want to make sure that you have something immediately or can match up with what your needs are. The other important part here is the payout percentages. Comparing payout percentages from one product to the other is okay, but with the Allianz 360, which we highlighted at the beginning of the show, you start out, if you were to put this in at age 60, you would start out at 5% payout option, but each year that you defer, your payout grows by 40 basis points. So if you wait for 2 years, your payout now for the rest of your life is 5.8%. That can be a material difference than being stuck at 5%. So that's something that you really got to pay a lot of attention to.
Okay, so you really need to do these numbers. You really need to crank these numbers out and compare before you go to your final trigger. So this really matters.
Yeah, and I think one thing that frustrates me is that we illustrate a ton of 10-year deferrals. That's just about every one of our illustrations because it maxes out the income. The reality is clients are turning this income on in about 2 to 2.5 years. So I say, let's take a look at reality and see what it looks like immediately as well.
If they're doing it that early, between 2 to 3 years, and not holding till 10, what's the difference in rate of return then?
Well, it just could be as difference as 80 basis points.
So it's significant. I mean, you're talking the rest of your life.
Yeah.
So when we're looking at income rider comparison charts, these comparison charts, we've tried to disclose and make all our disclaimers as much as possible because the nuances here per contract are just
We've made it as ugly as possible here.
Yes. But it really does give us the digest of what we need to make a really summary statement and be able to get in front of the client and walk them through this. Anything else you want to show us on the income chart?
The other important thing that I think that you really need to take a look at, and we talked about control of the trigger, joint annuitants. Many of our contracts in here allow you to choose a joint annuitant at time of issue or at time of when you turn the income faucet on. We prefer for those contracts when you turn the income faucet on, because it gives you control and flexibility about whether you want to have it off of one life or the second life. That's a key component.
So I can add this at the time that I'm going to make my final decision. I can decide one life or two lives.
Absolutely.
And it doesn't necessarily have to be your spouse. It could be a child, a grandchild, right?
Most of these are spousal.
They are
limited.
spousal.
Yeah.
Okay.
Mhm.
All right.
Yep.
All right, well, let's look at the SPIAs and DIAs. Now, again, we talked about this on another show. A lot of our agents are still being introduced to DIAs. I know it sounds funny. They've been around forever, but they become so popular lately. Give us just a real down and dirty definition, and then let's go to the grid.
Basically, it's a SPIA that is delayed, so that you put your money in, and that company is going to guarantee you a lifetime income that you can never outlive based upon your option at a certain starting point. What's nice about these is the issue ages are typically a little bit older. You still have a ton of flexibility, but if you look at this, our income rider spreadsheet was about 8 pages long. The delayed income annuity is really only 2. There are really only about 4 or 5 players in this across the industry.
Now, because we have a more limited inventory, is there much competition between these 4 or 5? Is there a difference between number 1 and number 5? Is it like 5%, 7% difference?
Depending upon the age and the benefit structure, there could be maybe as much as a 15% difference in the payout structure. What's also unique is when you take a look at Canix, you also take a look at how they're calculating mortality. And you can take a look at that by the exclusion ratio on non-qualified money. Their tax-free return can be significantly different depending upon how they're calculating life expectancy. So that's one thing that you need to dig deep into that as well.
I'm always wondering, are they really looking at the 2001 CSO on this, or have they upgraded using maybe the Society of Actuaries VBT relative risk tables in 2008? I often wonder why they're so different between carriers.
Yeah, it can be, like I say, it can be a dramatic difference between that when you think that everyone's looking off the same actuarial tables.
Well, you brought up a great idea, though. A non-qualified, I can pretty much tell how they feel about longevity on the basis of the exclusion ratio. So if that exclusion ratio is rather on the low side, what are they saying?
Yeah.
We're gonna see a person live a lot longer.
Yeah, absolutely, yeah.
So I kind of like the idea of some carriers have actually been a little behind the curve in their annuitization and their credit mortality modeling, and that could be to the advantage. And this is why we look at this and shop it with Canix or Annuity Bulldozer, some of these software systems that really look at side by side. Now, in delayed income, have you seen this market go up since we've started reintroduction to this? Has this market taken off?
This market has absolutely blossomed in really the last 24 to 36 months. New York Life was the first carrier that was really in it, anything significantly. We've seen Lincoln National Life join really here in the last 180 days with a very, very competitive product. I do want to point out the ING product is actually an index chassis. However, it looks, feels, and smells like a deferred income. You really don't get any type of growth off of the chassis and the index, and it's really meant to be an income play, pure income play.
And have you generated numbers off that and compared to the others?
Very, very comparable. What's nice about the ING product is it doesn't even get an exclusion ratio. Your cost basis comes out first. So it is true FIFO accounting on that particular product for non-qualified assets. It's a great planning tool.
That could be a
use.
huge play
Absolutely.
if you're doing some modeling. Well, that's all the time we have for today's show. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance department. Missed an episode? You can view all our past episodes at downtobusiness.ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. We'll see you tomorrow.